Welcome back. Let's talk cement now. This is our special segment, Quarter Se Quarter Tak, and Nigel has moved over to the big wall to give us the expectations from the cement industry in Q2.
Well, that's right. Today we're breaking down the Q2 FY26 earnings preview for the cement sector. A quarter that's marked by strong EBITDA growth despite soft volume trends. Let's dive into the key drivers then. First up, the cement sector is expected to post a strong 50% year-on-year growth in EBITDA. That's going to be supported by around 5 to 6% year-on-year increase in cement prices and benign input costs as well. This comes on the back of a soft base that we saw in Q2 FY25. However, the volume growth remains muted, which is eating partly into the benefits of improved pricing. Industry-wide volume growth is expected to remain under 5% or around 5% on a year-on-year basis, which is continuing the weak trends that have been observed over the last few quarters. This has been impacted by heavy monsoon season, an early festive calendar, and dispatch disruptions in the lead-up to September 22nd, when the GST rates were revised. That said, M&A activity has supported volume growth for some players among the large names. UltraTech and Ambuja Cements, where they're expected to lead with volume growth of around 10 to around 15%, thanks to the recent consolidations that we have seen in both those two names. Among mid-caps, JSW Cement as well as JK Cement, they could post as well 15% and around 10% growth respectively. On the weaker side, Shree Cement, Dalmia, Nuvoco, all of them are expected to see sub 5% volume growth. And Ramco, there's a chance that it could possibly report a flattish to a mildly negative number as well for the past quarter. Sequentially, the industry EBITDA per ton is expected to fall by around 200 rupees, could come in closer to around 900 rupees, around 880 rupees per ton. That's because of the modest price correction, seasonal cost uptick, as well as weaker operating leverage. Though on a year-on-year basis, the EBITDA per ton will look much better. The pet coke prices, they have started rising, but the full impact of this will only be seen in the fourth quarter. This could also set the stage for another price increase, which could effectively come in the second half of November itself. On the EBITDA per ton front, going by company-wise, well, UltraTech, the EBITDA per ton could dip to sub 1,000 rupees per ton. Shree Cement, with its focus on North India, it could clock the highest EBITDA per ton at roughly around 1,200 rupees per ton, while JK Lakshmi is expected to show strong improvement of a low base. However, Ramco's EBITDA per ton may improve by only around 120 rupees, but the overall EBITDA growth could be limited to just 15% growth because they'll be hurt by lower volumes. Well, from a valuation standpoint, while earnings momentum is strong on a year-on-year basis, well, investors will need to watch closely for sustainability of price hikes, volume recovery post the monsoon, and margin resilience as well, as fuel costs have hardened a little bit. Well, to help us out with how he's seeing the cement sector's numbers, we are joined by Dharmesh Shah, the research analyst at JM Financial. Hi, Dharmesh. Thanks a lot for joining in and good to have you on the show. Well, let's get to the profitability aspect first up, Dharmesh. The EBITDA per ton. Some brokerages are talking about 180 to 200 rupees per ton improvement on the EBITDA per ton front for the industry on the whole. What are you working with? If you could give us a rough number.
Sure. Good morning and thank you for inviting me to the show. So on a year-on-year basis for our coverage companies, we are expecting around 35% improvement in the EBITDA per ton, which is like broadly 250 to 260 rupees per ton. And this will be led by the 5 to 5.5% improvement in the realization on a pan-India basis, around 4% kind of volume growth and marginally lower cost on a year-on-year basis. But being this will be a seasonally weak quarter, on a sequential basis, we are expecting around 200 rupees decline in the EBITDA per ton, which is like 16 to 17% decline. And this will be mainly led by the price fall, which is around 1.5% sequentially on a pan-India basis adjusted for the GST and operating deleverage. So overall, we are expecting around 250 rupees improvement in the EBITDA per ton on year-on-year basis and around 200 rupees decline on a sequential basis.
Got it. Dharmesh, I want to ask you about the volumes. These numbers are going to look good on an absolute EBITDA, because of some price increases, benign input cost as well. But the volume growth is still not coming, Dharmesh. Gone are the days where we used to see 8-9% growth. Now we have to be satisfied with around 5%. However, there is optimism the second half of the year things will improve. What are the volume growth estimates you're working with for the industry on the whole? And do you foresee a recovery in the next 2 quarters?
Yeah, so generally we don't see both the things come together, volume and price. So the first half will be largely the price gain, where the industry has seen a 5 to 5.5% kind of price improvement. And despite the low base, the volume growth is likely to be just 4% in the first half. Given the base of the last year is also strong in the second half, where the volume growth has happened 8%. So in this year also, in the second half, we are expecting the volume to improve, and it will be like in the range of 7 to 8% volume growth for the second half. So on a full year basis, overall, we are expecting 5.5 to 6% volume growth versus earlier expectation of anywhere between 6 to 7%. So we are tapering down our volume growth estimate by 50 to 100 bips for FY26.
Okay, all right. Dharmesh, if we have to look at a positive surprise from this past quarter's numbers, if you could name a couple of stocks where you see a positive and maybe a negative surprise as well.
So I will say that the result will start from the 15th October onwards. But on a relative basis, the price decline in the northern market is relatively lower on a sequential basis. So Sri Cement, in terms of the volume growth, will be muted, but in terms of the profitability, unitary EBITDA, they can see a much better EBITDA per ton compared to industry and lower decline as compared to industry, given that their focus is on the brand improvement side, and secondly, the north region had witnessed a lower price decline. So the north-based company can relatively outperform compared to industry, which is like Sri Cement. While on the other side, the southern-based companies like, say, Ramco Cement, where also the volume growth muted, but sequentially we have seen a higher price decline in the southern region. So the Ramco Cement kind of company can see a relatively higher decline in EBITDA per ton compared to industry.
Got it. Okay. So North will continue to do well, and South could lag a little bit just for the past quarter. Wondering about the UltraTech Cements commentary post the first quarter when they said that they believe South could be the new North, and they went ahead and then did that OFS on India Cements. That discussion for another time. But tell us, what are your top buy ideas and how do you position yourself? Some of these mid-cap companies, if consolidation has to continue, there could be some kind of M&A activity. So would you be staying with the top bosses, the big large cap names, or do you like some of these mid caps as well?
So see, this post GST cut rate implementation, and gradually we expecting that the next few months or the next couple of quarters, the industry will focus more towards the volume growth rather than the prices. So we will likely to bet on the large caps only. So we will prefer to go with the companies which are having a pan-India presence and the stronger balance sheet. So in the large cap, we will prefer the UltraTech, while in the mid cap space, we will prefer the JK Cement. And from a consolidation perspective, we believe that the large part of the consolidation is over. So we don't want to play consolidation theme for the next couple of quarters perspective.
Okay, all right. And on pricing, since that has been the positive for the last couple of quarters, I spoke about volumes, which are still lagging. But on pricing, at least the prices have held out, and in fact, they're marginally moved up. Even in the monsoon, we didn't see that kind of deterioration in prices. Now, X of this GST adjustment, what is the expectation with regard to pricing year on? Do you think for the remainder of the year, if these prices hold, will be good enough? Or are you factoring in a couple of price hikes as well?
So those GST rate cut implementation and second half can also see a good capacity addition. We are not expecting any material price hikes to happen. Rather, if the prices is hold on, that will also be positive from the industry perspective. So we are expecting if any material price hikes to happen, it can happen only from the starting of the next financial year onwards. And we are not building any material price hikes to happen from here on for the next couple of quarters. And the industry may shift towards the volume side rather than the price improvement.
Got it, Dharmesh. Good to have you on the show. I think it's one of the first times that we're getting you. Thanks a lot for joining in and giving us, your take on the cement pack. And we request you to join in once the results start flowing in and give us your first take on that front as well. So that's about the cement pack. Watch out for, good improvement in terms of EBITDA. However, volume uptake needs to come about, and pricing, according to Dharmesh, if it holds steady as well, will be good enough in terms of an outcome.